Hi, it's Luna Petty, your friendly neighborhood mortgage broker with Unique Financial. Let's talk about what's happening with the mortgage market right now. Mortgage rates didn't move much on Friday, but they're sitting right near the highest levels that we've seen in the last 2 months. Think of rates like kids on the playground. They keep running back and forth, but they're quarantined in a small little area. Well, that's what's happening right now with the rates. They're not crashing, they're not soaring, they're just stuck within a few percentage points up and down. It all comes down to bonds and stocks, the two big money groups that tug on rates like a seesaw. Early Friday morning, people were buying a lot of bonds. That usually helps rates go down. Stocks were dropping too, which usually helps rates go down. But by the 9 a.m. hour, everything flipped. Stocks jumped up, bonds got weaker, and rates lost all of their progress that they made earlier that Friday morning. It's like both markets woke up at the same time and said, never mind, let's go the other way. Moving on, how is the market reacting? According to the Mortgage News Daily, last week mortgage applications went up a little bit, just 0.6%. Not a big party, but not a drop either. Refinances dipped 3% from last week. But here's the wild part, refi activity is still 147% higher than this time last year. Why? Because even slightly lower rates compared to last year make refinancing look way better than it did in 2023 and early 2024. Also, people refinancing are mostly folks with bigger loans, even though the average refi loan size just hit the smallest number in a month. Purchase applications went up 6% last week, according to Mortgage News Daily. That's a 31% jump compared to last year. Translation: people who sat out in late summer and early fall are getting back into the game. Seasonal slowdown is over and buyers are moving again. In late October, rates were sitting at their lowest point in a year. Now, since then, they've drifted a bit higher because the Treasury bonds leveled out after the Fed's last meeting. But even with that small increase, today's rates are much lower than the peaks we saw in 2023. That's why buyers are stepping back in, and why refinances are still running high. The big thing this week is the jobs report on Thursday. The forecast says about 50,000 new jobs, but private data is showing hiring is slowing down. Here's the simple version. When companies hire fewer people and unemployment rises, bonds react in a way that usually helps mortgage rates fall. Some Fed members keep saying that the job market is fine, but layoffs are rising and companies are replacing humans with automation. That's why the Fed keeps talking so carefully. They know things are slowing down. The shutdown lasted 43 days, and now that it's over, a ton of delayed reports are about to hit all at once. Expect some choppy, messy rate movement for a bit while the market sorts through all of that new information. QT, or quantitative tightening, is when the Fed shrinks its balance sheet. They're stopping that on December 1st. That means the Fed stops letting money fall off their balance sheet and they start reinvesting again. That takes some pressure off of interest rates, and it does not mean rates will drop suddenly, but it helps the whole market calm down. Rates are higher than a couple of weeks ago, but they're not out of control. Buyers are coming back and refinances are strong. And the next big move for rates comes from the jobs report numbers, not from the headlines. If you're thinking about buying or refinancing, text me or DM me. I'll run the numbers for you so that you can know exactly where you stand. Thanks for watching.